In this lesson, we are going to finish up our discussion of credits. We've already talked a little bit about some of the credits that are available for taxpayers with qualifying children or dependents, and we talked about some education credits. And so this lesson, we're just going to talk about a couple more credits, and then we'll be ready to move on to the next portion of the return. Now, we've been discussing the differences between non-refundable credits and refundable credits. Remember, non-refundable credits can reduce tax down to zero, but that's all. And refundable credits can reduce the tax down to zero and beyond. In this lesson, both of the credits that we're going to be talking about are non-refundable credits, and they flow onto the return through Schedule 3, our additional credits and payments in Part 1. Line 4 is the Retirement Savings Contribution Credit, and line D of 6 is credit for the elderly or disabled. And you'll see that both of those have another form that will be attached. And looking at our intake form, Form 13614C, where do we get this information from? Well, the credit for the elderly and disabled is something that we kind of find up towards the personal information, but for the contributions to retirement savings is here in Part 4, expenses, where we've been spending a lot of time lately. Contributions to a retirement account, and you see there's some various retirement accounts, and maybe our taxpayers will have checked the box there. Let's begin by talking about the Retirement Savings Contributions Credit. And this screening sheet comes from Publication 4012, Tab G. If we follow along the steps, we can see that the taxpayer needs to have made contributions to a qualified plan. They need to have an adjusted gross income under a certain amount, and the taxpayer must be age 18 or older, not be a dependent, and not be a full-time student. And it's really important with this credit because TaxSlayer will calculate the amounts if we enter information from the W-2 correctly, but we also need to remember that people can be making contributions to an individual retirement account, and if they have done so, we need to make sure to enter that so that TaxSlayer can do the heavy lifting for us. Let's look at some places where we can figure out if this person has made qualifying contributions. And the first place we'll start here is the Form W-2. And there's a few boxes that can kind of give you clues that this is something we should be asking about. Remember, our box 12 has a bunch of different codes that refer to different types of items that have some sort of a tax consequence. So if you see in box 12 a code D, E, F, G, H, S, AA, or BB, these are codes that tell you that the taxpayer has put away some money into some sort of a qualified contribution plan. And I know you're going like, wow, that's a long list of codes. How am I going to remember that? Well, along with the W-2, very often on the back or somewhere in there, there are usually instructions that have a bunch of box 12 codes. So you can usually look it up on the form or on a page that came with the form. Or worst case scenario, you can always Google box 12, W-2 box 12 codes, and there's an abundance of pages and resources available that can help you figure out what those various codes mean. In addition to that, we have box 13. That's that box with all the little check boxes in it, 3 little check boxes. The middle box there is retirement plan. So if that box is checked, again, we want to be talking with our taxpayer and asking them questions about, oh, I see you put into a retirement plan. Can you tell me a little more about that? And then box 14. sometimes there's information in there regarding voluntary retirement contributions, and they'll usually be marked as qualifies for Form 8880. And then you'll know that you'll be looking at entering some information into TaxSlayer about this credit. Now, contributions don't just stop at the W-2. Remember, people can contribute to an individual retirement account or a Roth IRA. And those would not show up on the W-2 because our taxpayers would have made them on their own. So it's important to ask, did you contribute to a traditional IRA or a Roth IRA this year? Also, some of our taxpayers might have made contributions after the end of the tax year. As long as they make those contributions before the filing deadline, so that's going to be most likely April 15th, then they can count those towards this contributions credit as well. And also the designated beneficiary of an Achieving a Better Life experience or an ABLE account, if they made a contribution to their ABLE account, then that is another contribution that qualifies for this credit. It is important to note, though, that if our taxpayers had distributions from these types of accounts, those reduce the eligible contributions for this credit. So if you're seeing a current year form 1099-R, again, 1099-R is for our pensions, annuities, retirement or profit sharing plans, IRAs, insurance contracts. Those reduce the amount of eligible contributions that can be counted towards the credit. Also, distributions made from the 2 years prior reduce the eligible contributions. And then, of course, if our taxpayers have had a distribution between January 1st and the tax filing deadline of the current year, that's also going to reduce the eligible contributions. There are some types of distributions, however, that don't reduce eligible contributions. Just if this sort of thing comes up, it's good to check in your Publication 4012, tab G, and there's a list of distributions that do not reduce contributions. But this is something that you're going to want to have cued in your mind, that if somebody has contributed to one of these plans but also received a distribution, we're going to probably have a reduction, but we're going to check just in case we don't need to. And then the maximum contribution that can be counted towards this credit is $2,000 per person per year. And this little chart comes from Publication 4012, tab G, and it just kind of goes over the calculation. TaxSlayer is going to do the calculation, but it's important to be aware of what what the credit might look like when you're done putting in the information. So again, we have our brackets. If AGI, adjusted gross income, is over a certain amount but not over a certain amount, then if our taxpayer has a certain filing status, they will be able to multiply the amount that they put in by the decimal. So the 0.5 means 50% of what they put in they get back as a credit. And you can see as income increases, or as adjusted gross income increases, that the credit sort of slowly phases out, or quickly phases out, to where eventually our taxpayers can no longer claim it. And then we did look at Schedule 3 earlier, which is where the credit will end up in between this form and the 1040. This is the 8880, and this goes through the calculation of the credit as well as some qualifying questions to see if our taxpayer qualifies to take the credit. So moving on from the retirement savings contributions credit, now we'll start talking about the credit for the elderly or the disabled. And here again, this is a credit that you really don't see super often because the income limits are so low, but you do occasionally see it. And so again, we have a screening sheet if you run across a situation where somebody has quite a low income and they would be considered elderly or disabled. It's in publication 4012, tab G again, and it just runs you through some questions. Was our taxpayer married at the end of the year? If yes, they go to step 2. If no, they're going to skip down to step 4. So let's say yes, they were married. And then step 2 asks, did you live with your spouse at any time during the year? And then it says answer no if you are qualified to be considered unmarried and file as head of household. Yes, you continue on to step 3. No, you would skip to step 4. So let's say yes, step 3. And then step 3 is, are you filing a joint return with your spouse? If they are, yes, they can move on. If not, they aren't a qualified individual and can't take this credit. So where this is leading us is if our taxpayers are married and they lived together, they need to be filing a joint return. Otherwise, they don't get to claim the credit. And then step 4 is the question, are you a U.S. citizen or resident alien? And checking for age, were you 65 or older? And if they were not 65 or older, then were they retired or permanently and totally disabled? And then they need to have reached the mandatory retirement age before this year, and that is something that is determined by their employer. And then did they receive any taxable disability benefits if they were disabled, taking this credit because they're disabled and not because they're elderly? And here is our income limits, and as I said, they're pretty low. So if somebody is single head of household, qualifying widow or widower with a dependent child, and their adjusted gross income is $17,500 or over, they don't qualify for the credit. Or if they have non-taxable Social Security and other non-taxable pensions and annuities and disability income, if it's over $5,000, they can't take the credit. And you can see we have slightly different limits for married filing joint returns, and one or both spouses might qualify, but again, incredibly low income limits, which is why we don't really see this super often. If we do see it, though, the information flows onto the return initially on Schedule R, and that's where it goes through the determination of whether our taxpayer qualifies and the calculation. There are some Schedule R and tax layer entry instructions in the publication 4012, so if you do see it, just know that you'll be looking up 4012 to figure out where to enter everything. And just remember that even if we have a taxpayer who is going to have non-taxable Social Security benefits, they need to get entered into the return because that's important in determining whether our taxpayer is going to qualify for this credit. And here's the final destination on the Form 1040, where all of our non-refundable credits are going to go, other than our non-refundable child tax credit and credit for other dependents. That was the line above, but line 20 is where everything else gets compiled from Schedule 3 onto the face of the 1040.